Stocks are falling as tech companies drag down the market. The tech names that led the rally are now falling behind. The big name tech companies suffer their worst single day drop since back in March 2020, and investors are rotating out of tech companies as the continuous trend of selling out of the high flying names and rotating into more value and some more economy reopening plays has continued over this past week. So the stock market is red right now and investors are panicking. Some of the high-flying growth companies that doubled or tripled throughout 2020 have now fallen by over 30%. So in this video, we're going to take a look at two dividend ETFs that may be a nice alternative to the tech sector right now if you're getting destroyed by these market pullbacks. And of course, whenever companies do begin to fall, it may lead to great opportunities to buy the dip, but if you already believe you're overweight in that industry and you want to have a little bit less volatility in your total portfolio, adding a low-cost, diversified blue-chip dividend ETF that provides their investors with long-term capital and dividend growth may be a nice way to balance out your portfolio, add a little bit of income, and get exposure to some more stable names on the market. So in this episode, we're going to take a look at two dividend ETFs with different strategies. One is more focused for younger investors who are in the market for the longer term with nice capital and dividend appreciation. And the second is a more high current income portfolio that might get rid of some long-term capital growth, but provides you with much higher current income at this current point in time. So we have two different ETFs we're going to go over in this episode. We're going to take a look at their performance, their top holdings, and the fun facts. But before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and as the tech sector continues to see a major pullback, dragging the overall market down, investors are now beginning to transition, reduce some tech, and move some capital into the high-flying dividend companies that have been staples of our economy over the past few decades. And now if we take a look at that first dividend ETF, it is ticker SCHD, which is Schwab's US Dividend Equity ETF. It currently trades for around $77 per share, and over the past 12 months, it is up by 56%. And at this current level, this is a massive fund with over $24 billion of assets under management, and it provides investors with a nice high 2.7% quarterly dividend yield. And buying into this fund will cost you very little with a minimal expense ratio of only 0.06. And over the long term, even for a dividend-focused fund, it has provided investors with some great capital appreciation of over 92% over the past 5 years, and this return does not include a reinvested dividend. And if we jump over to the company's website, the objective of this overall ETF is to track the US Dividend 100 Index. It provides a straightforward, low-cost fund to get exposure to dividend companies. And why I chose this ETF over its competitors for this episode is because of this highlighted point right here. SCHD invests in stocks that are selected for their fundamental strength relative to their peers based on financial ratios. So if you're a subscriber to the channel, you know I'm a big financial guy. For every stock we evaluate, we take a look at the financial statements. I make sure the cash flow, the balance sheet, and the income statement are all going in the right direction. And that's what this fund is doing. Instead of owning all of the dividend-paying companies and owning 300 or 400 different holdings, right now it only has diversified across 103 top names. So essentially, if there's two competitors within a similar industry and the fund only wants to hold one, it will actually take a look at their financial ratios and choose the relative stronger one instead of just owning both and having a more diversified approach. So although you're getting less holdings in this ETF, I think the holdings are going to be stronger compared to some of the other funds you can find on the market. And this SCHD was created back in 2011. Like we saw, they have over $24 billion of total assets under management, so this is a massive ETF. Right now, the expense ratio is very small at only 0.06%, and the total net asset value is over $77. And right now, this fund is broken up with an average market cap of around $120 billion for its holdings and a price to earnings ratio right around 21. And of course, with dividend companies, you are going to collect some nice return on equity, which comes in right around 31% for this ETF. And if we take a look, over the past 5 years, it has performed extremely well. And the average annual return over this past 5 years is right around 17%. 17% annually for a dividend-focused portfolio is absolutely incredible. And since 2011, when the fund was created, it has averaged over 15% per year. 15% per year, that's fantastic. No one can ever complain about getting those returns over a longer term span. And yes, I understand the past decade, we've been in one of the best bull market evers, but just the nature of this ETF, focus on the strongest dividend paying companies, I believe going forward, this return will continue over the longer term. And if we take a look at this ETF's top holdings, it is made up of Home Depot, IBM, Pfizer, Texas Instruments, BlackRock, Cisco, Amgen, Pepsi, Coca-Cola, and Merck. And right away, I am a big fan of these holdings. And I like how they're diversified, where there's not one single company that makes up a large portion of the fund, and the top holdings sit right around 4%. And in my personal dividend portfolio that I show on the channel and we track my progress and my growth, I own 6 of these top 10 companies. I own Home Depot, Pfizer, Pepsi, Coca-Cola, Merck, and BlackRock is at the top of my watch list, and I do believe will be my next purchase for my portfolio. And Texas Instruments is another name I have on my watch list, and I may start a position on any future dips in the company. So right away, if I choose to invest in these names personally, I know I must like them, they must have strong financials, and I understand why they're making up the top 10 holdings of this ETF. And once again, as a dividend paying company, I like owning the brands that we see and we use in our economy every single day. Home Depot, one of the biggest and baddest retailers in the market, I don't see going anywhere anytime soon. BlackRock, one of the strongest financial companies in the world. Then of course Pepsi and Coca-Cola, dominating the snack food and the beverage sector. So overall, some of the very good companies at the top weighting of this ETF, and you'll get exposure to some of the big boys in the market. And if we take a look at the sector diversification, information technology right around 20%, financials at 20%, consumer staples at 14.5%, some industrials, healthcare, and the remaining sectors. And once again, another reason why I chose this ETF versus the competitors is because one individual sector does not make up much more than 20% of the overall fund. Some dividend ETFs you can find on the market, one single sector will make up 30 to 45% of the total weighting of the ETF. So although you own an ETF and you believe you're getting nice diversification, you're really not, and those funds are focused into one single industry. But in SCHD, the fact that the top sector only makes up 20%, and you can see it's somewhat nicely spread out across the top 5 industries, I believe your overall fund will be nicely diversified, your capital spread out in a very efficient manner. And one thing, of course, we have to discuss is the long-term dividend growth of this ETF's distributions. As a dividend investor, we like collecting the starting 2.7% yield, but over the long term, we want to make sure our capital is growing as inflation grows and cost of living goes up as well. And if we take a look at the long-term growth of their quarterly payment, we can see it is doing just that. Back in 2012, they were paying out around 12, 14, or 20 cents per quarter. But then in the recent payments, it's gone as high as 54 cents, 60 cents, and then the latest payment was right around 50 cents per share per quarter. So over the past few years, the total annual dividend and the quarterly payment have been growing at a decent rate as well, so your capital is earning you more and more money over the long term. So definitely one of the strongest dividend-focused ETFs on the market. If you want to take a passive approach to your dividend investing, SCHD is definitely a fund worth doing some research into. And even if you're primarily a growth stock investor or you prefer to pick your own companies, having a small allocation of your portfolio to a passive dividend ETF like SCHD may provide you with greater diversification, some passivity, a little bit less volatility, and some nice quarterly cash flow as well. So definitely something to keep in mind and maybe worth speaking with a true qualified professional about for your own investing journey. And then of course, now if we take a look at the second ETF in this video, it's going to be ticker SPYD, which is SPDR's S&P 500 high dividend ETF that currently trades for around $41 per share and is up 59% over the trailing 12 months. And right away, this ETF is very different from SCHD. This portfolio is focused on high current dividends, and we can see the yield on this ETF is at 4.5%. They have around $3.6 billion of assets under management and an expense ratio, very small once again, at only 0.07%. So overall, this ETF is for a different type of investor. It's for the individual who needs high current income at this current point in time. Whether they're approaching retirement or they want to live off their dividend cash flow, this portfolio provides, like I mentioned, 4.5% at this current rate with the growing payment over the longer term. And this ETF is designed to own the 80 highest yielding companies in the S&P 500. So you're getting exposure to all the large cap names that offer their shareholders a nice high yield. And if we take a look, right now this fund has 78 different companies, and their 3 to 5 year estimated earnings per share aggregated across all the holdings is around 8.6% per year. So even for these underlying higher dividend companies, you're still seeing their earnings grow at a decent amount every single year as well. And from their actual website, we can see that 4.5% current yield for the company. And over the past 5 years, it has returned around 9.5% per year to their investors. So right now, this fund is underperforming SCHD. And like I mentioned right away, that's the trade-off between getting the higher current income versus a more passive, long-term approach with lower current yield, but greater share price appreciation. And this fund was created back in 2015, so it's been operational for just over 5 years. And for an investor who's living off the income or needs that current income right now, still collecting an over 9% annual return based on capital appreciation and cash flow is still doing very well. And if we take a look at the top fund holdings, the top 5 include Seagate, Hanesbrands, Regency Centers, Iron Mountain, and Fifth Third Bancorp. So right away, you can see not the most popular companies on the S&P 500, but definitely the names that provide you with some great income. And one thing I really like about this ETF, once again, I did do some research into other high dividend alternatives, is because the top weighting only makes up 1.6%. And all of these companies throughout the top 10 make up very similar equity values in the overall ETF. And why I like that is because with a high dividend approach, you are getting a little bit more risk of a few dividend cuts coming every year or every few years. So if this one was highly weighted in the top 10 holdings, that put a lot of risk for your current income. Because if 1 or 2 of the top 10 cut their dividend, that put you in a tough spot. But right away, with the largest holding only making up 1.6% and the allocation being spread out pretty equally among the largest holdings, even if 1 or 2 or 3 of these cut their dividend over the shorter term, your overall passivity in the income of the portfolio will not be hit too hard. And if we take a look at the sector diversification, financials does make up the largest weighting of around 24%. Then we have real estate making up 18%, energy at 14%, utilities at 12%, and tech making up around 6.5% of the overall ETF. So some sectors that will be operational for the long term are the big financial names, the real estate companies, and energy, and I don't see those sectors dying down anytime soon over the next few decades. So as a whole, definitely another alternative for a low-cost dividend ETF, and if you want that high current income coming into your portfolio every quarter, SPYD is definitely a brand to take a look at. So now we're going to kind of wrap the video. We took a look at 2 of the strongest dividend ETFs on the market. They offer you a very low fee to get exposure to some of the strongest dividend companies there is in the American markets. And of course, you can go with SCHD for some long-term capital and dividend growth with a lower starting yield and a more well-rounded diversified portfolio, versus you can go for the SPYD for some higher current income at the current level. So 2 options to take a look at. I hope you understand the difference between both and you take a look at the top holdings, do some research, and speak to a true qualified professional. Remember, I am not a financial advisor. Nothing we discuss is financial advice. I'm just a random guy on YouTube. And as we've seen these major headlines that the tech sector has gone down in a huge way over the past few weeks, now might be the time to kind of balance out a portfolio with some strong dividend paying companies. So thank you for watching to the end. I want to appreciate you. I thank you. Leave me a comment down below, and I will see you in tomorrow's video.